Martin Volkov walked into his manager's office in Budapest in the spring of 1944 and handed him an envelope. Inside was every banknote he had saved over 4 years of loyal work, nearly 2,000 pengos. He asked his manager, a cautious man named Tibor, whether he should keep the cash or move it somewhere safer. Tibor looked at the envelope, looked at Martin and said, "Keep it. Paper is paper. It has always been paper." Within 18 months, Hungary had experienced the worst hyperinflation ever recorded in human history. Martin's savings could not buy a single loaf of bread. Tibor had done the same thing with his own money. Neither man was stupid. Both simply believed, as most people do, that the system holding their wealth was more durable than the crisis surrounding it. They were wrong about the one thing that mattered most, not the crisis, but the container they chose to survive it in. The most dangerous financial mistake people make before and during wartime is not failing to predict the war. It is continuing to trust the containers that peacetime built. Every financial instrument, every bank account, every bond, every pension fund, every insurance contract is a promise made by an institution that depends on a functioning state. When the state fractures, the promise does not simply become uncertain, it disappears. Quietly, legally, completely. The money is still there on paper. The paper just no longer means anything. Look at what happened in Spain between 1936 and 1939. When the Civil War began, the Republican government in Madrid physically moved the nation's gold reserves, approximately 510 tons, to the Soviet Union for safekeeping. The people who owned businesses, land and peseta savings were left with assets denominated in a currency that was being actively contested by two governments simultaneously. Those who survived financially were not the wealthiest before the war. They were the ones holding assets that did not require institutional validation to function. A farmer who owned his land outright and could produce food had more real wealth than a banker holding certificates in a disputed currency. The mechanism was not ideology. It was the simple logic that value which requires a third party to confirm it is only as stable as that third party. That logic travelled forward in time without changing its nature. In Vietnam, between 1975 and the early 1980s, after reunification, the new government issued a series of currency reforms designed to control the economy and eliminate the financial influence of the South Vietnamese merchant class. Overnight, old banknotes became worthless. Savings accounts were frozen or capped at conversion limits that wiped out most of what families had accumulated over decades. The ethnic Chinese merchant community in Saigon, many of whom had already survived one political transition, had historically maintained portions of their wealth in gold leaf and physical gold tails, a practice rooted in distrust of paper instruments going back generations. Those families lost significantly less than neighbours who had trusted the banking system. Not because gold is magical, but because it required no permission to remain valuable. Permission. That is the word that connects these stories across continents and centuries. Every modern financial asset, from a brokerage account to a government bond, requires someone's permission to access. A bank must allow you to withdraw. A government must honour its debt. A pension administrator must process your claim. In normal times, permission is granted so automatically that we forget it exists. In wartime, permission becomes rationed, delayed, rerouted, or revoked entirely, sometimes with full legal justification, sometimes without any at all. Cyprus in 2013, though not a war, showed the mechanism in peacetime clarity. A government and its banking partners simply took a percentage of deposits above a certain threshold to recapitalise failed banks. Account holders woke up to find their savings had been reduced by institutional decision. No war required, just a crisis deep enough to make the permission structure visible. The Dutch experience in World War II completes a different angle of this picture. During the German occupation from 1940 to 1945, the occupying authority required Dutch citizens and Jewish families in particular to register financial assets, bank accounts, securities, and valuables, through official channels. The registration created a map. The map was used for confiscation. Those who had not complied with pre-war registration requirements, either because they distrusted official systems or operated in informal economies, were in some cases harder to locate financially. The lesson was not about legal compliance, it was about visibility. Financial assets that exist within legible institutional systems are assets that can be found, traced, frozen, or redirected by whoever controls the institution. Every account number is a coordinate. Every registered holding is an address. In peacetime, that visibility is how your bank protects you, how your government insures you, how the system knows where to send the deposit guarantee when something goes wrong. Legibility, in peacetime, is a feature. In wartime, it is a liability. The same infrastructure that routes your paycheck to your account on Friday morning can route a freeze order to that same account on Monday, and the technical process is identical. The system does not change, only the instruction does. What these examples share is not a single villain, no single government, ideology, or policy. There is no political system with a clean record here. The Soviet-aligned government in Vietnam did it. The democratic government in Cyprus did it. The fascist occupation in the Netherlands did it. The nationalist government in Hungary allowed it to happen through fiscal mismanagement rather than deliberate confiscation, which from the perspective of the person holding the worthless banknote is an irrelevant distinction. What they share is a structure that repeats because human societies, regardless of their values, tend to respond to existential fiscal stress with the same sequence of moves. First, capital controls are imposed to prevent wealth from leaving the country. Wire transfers are blocked, foreign exchange is rationed, borders become financial walls as much as physical ones. Second, currency is devalued, either formally through official rates or informally through inflation, to reduce the real cost of government obligations. The debt stays the same number, the number just means less. Third, financial assets held within the institutional system are either taxed heavily, frozen, converted at unfavourable rates, or simply lost in the collapse of the institutions themselves. Fourth, and this is the part that rarely appears in history textbooks, the people who understood this sequence in advance and held a portion of their wealth outside the institutional permission structure in physical form, in foreign jurisdictions, in assets requiring no third-party confirmation, retained more of their economic life than those who did not. This is not a conspiracy theory. It is a recurring administrative response to fiscal emergency, documented across political systems from communist to democratic to autocratic, and the documentation is not in fringe literature. It is in central bank archives, post-war economic commissions, and the memoirs of finance ministers who had to implement these measures and were honest enough decades later to describe what they actually did. The practical translation of all this history is not about fear. Fear is not useful here. Fear makes people hoard, panic, and make decisions in a single afternoon that they will spend years regretting. This is about something quieter, the architecture of what you hold. Every financial asset has a structure, and that structure either depends on an institutional chain or it does not. Financial assets that require institutional permission to access carry a hidden cost that does not appear on any statement. That cost is not a fee. It is the exposure to what happens when the institution granting the permission is stressed, captured, collapsed, or simply instructed by a government to treat your assets differently than it did yesterday. Physical assets held in your direct custody carry a different set of costs: storage, security, the friction of converting them into something spendable, the risk of loss or theft. But they do not evaporate when a bank's board meets in emergency session at 2 a.m. They do not convert at an unfavourable rate because a currency reform decree was signed while you were asleep. They remain what they are. This is not an argument against banks or governments in normal times. They provide real services, real protections, and real efficiencies that have no equivalent outside the institutional system. It is simply a recognition that the same system that efficiently manages your wealth in peacetime can efficiently remove access to it under stress, and those two functions live inside the same architecture. The distance between them is smaller than the annual returns on your savings account suggest. In some cases, that distance is a single executive order. The assets most people carry into a crisis are almost always the ones most exposed to institutional permission risk. Savings accounts require a bank that remains open and solvent and cooperative. Brokerage accounts require an exchange that continues operating, and a regulatory environment that does not freeze trading. Pension funds require a sponsoring institution, an investment manager, and a government framework that continues to honour its obligations to retirees. Government bonds require the government that issued them to remain capable of and willing to redeem them, and governments under severe wartime fiscal pressure have a long history of restructuring, inflating away, or simply defaulting on internal debt while maintaining international obligations for diplomatic reasons, leaving domestic savers holding the shorter end without any mechanism for recourse. Corporate bonds require the corporation to survive and the courts to function well enough to enforce creditor claims. Physical cash in a collapsing or occupied currency requires the political entity behind that currency to maintain its legitimacy, and when two governments are simultaneously claiming legitimacy over the same territory, the cash in your wallet is a bet on the outcome of a war you cannot control. None of these assets are worthless in peacetime. All of them have shown, repeatedly and across different political systems and different centuries, the capacity to become inaccessible or functionally devalued precisely when they are most needed. The assets that have historically retained navigable value across wartime transitions, not perfect value, not immune from disruption, but usable value that did not require a functioning institutional chain to access, share two characteristics. They are physically portable or otherwise jurisdiction independent, meaning their value does not stop at a border or a capital control order. And they require no institution's active cooperation to confirm their worth, meaning two strangers in a ruined city can agree on what they are trading without a bank statement, a clearinghouse, or a government attestation. Since 2022, central banks globally have collectively increased gold reserves at rates not seen since the mid-20th century, a period that, historically, corresponded with the final decades of the Bretton Woods system and the transition away from dollar convertibility. Several large economies, including Poland, Germany and Hungary, have either repatriated gold stored in foreign vaults back to domestic custody or publicly announced policies to do so. Switzerland modified its rules on financial reporting thresholds for foreign accounts held by its residents. The Bank for International Settlements, the central bank of central banks, published updated guidance on reserve asset diversification that explicitly discussed non-dollar, non-euro holdings. Multiple NATO-adjacent countries expanded civil preparedness guidance to include financial readiness sections that specifically mentioned maintaining accessible cash reserves and hard assets outside the banking system. Finland, Sweden, and several Baltic states issued updated civilian crisis preparedness booklets in 2023 and 2024 that addressed personal financial resilience in terms that would have seemed alarmist 10 years earlier. These are not predictions. They are observable institutional behaviours, fully documented and publicly available, and institutions, particularly large ones with access to long-range strategic planning and threat modelling that never appears in press releases, tend to hedge in the direction their analysts point. When the institution managing everyone else's money quietly adjusts the composition of its own holdings, the direction of that adjustment is data. The man who loses everything in a war rarely loses it on the battlefield. He's not usually a soldier. He's a retired teacher, a shopkeeper, a mid-level civil servant who spent 30 years doing everything correctly, saving consistently, investing prudently, trusting the institutions his society told him were trustworthy. He loses his savings in a bank that closes on a Tuesday and never reopens. He loses his pension in a currency reform that converts his accumulated decades at a rate that makes the math cruel. He loses his bonds when the government that issued them decides, quietly and legally, that its obligations to international creditors take precedence over its obligations to domestic retirees. Martin Volkov from Budapest understood all of this, but only after. He understood it the way most people understand it, which is through personal experience of the thing itself, after the window for acting on the knowledge has already closed. The only difference between him and the people who came through the same period with their economic footing intact was not intelligence, not income, not connections. It was that they had learned the lesson from someone else's crisis rather than their own, and they had made one or two structural decisions years before the crisis arrived